Good morning and welcome to the LIONTRUST Asset Management PLC half-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time just by using the Q&A tab situated in the right corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you to CEO John Irons. Good morning to you, sir.
Good morning, ladies and gentlemen. We're here this morning to present the half-year results for financial year 25. Myself, John Irons, Chief Financial Officer Vinay Abrol, and Marketing Simon Hildry are here. It's been a year of challenge and change within the industry and within LIONTRUST, but we continue to strive to be the best we can. And stay true to our core beliefs of active management and excellence in brand and distribution. We've diversified our product range, we've broadened and strengthened our technological data and digital capability to ensure we continue to serve our clients to the best standards and the standards they expect. The highlights or points for the half-year financials. So net flows, outflows of 2.1 billion, AUM a little over 26 billion, adjusted profit before tax of 25.8. Business still maintains a strong capital position and nearly 60 million there, and we have maintained our financial half-year dividend of 22p. If I just talk maybe a touch there, the dividend at LIONTRUST has become high as a percentage, getting up to 16-17%. That's had some commentary in the press and from analysts as to whether that dividend could be maintained through more challenging trading periods. The directors and management team were very keen to target a dividend of 72 pence for the financial year. And if I just say that, we realise that that dividend may be slightly uncovered, maybe somewhere around 4 to 6 million pounds by the end of the year. If you look at the way our dividend is paid out, we have the interim now. We're looking at a final year dividend of 50p in the summer. This time, in a year's time, we'd be following through with the next interim. So really, the only strain on the dividend is about 20 months away. And what we were keen to do by that is to give guidance that it gives us time to look at the underlying performance of the business. We'll go into reasons why we're confident that that position is maintainable, sustainable. But we wanted to move away from short-term comments about does the dividend sort of need to be cut or not. So in reality, it's a 20-month period where we have to make that time. And the benefit of that to us is that we can continue to monitor the underlying core trends of the business, which we believe have, we have more grounds for optimism on. Alongside that, there'll be a small share buyback, again, a reflection of confidence in the business and the fact that we think that the shares are trading at the wrong price currently. On top of all of that, Vinay will go into a business transformation program, which will result in cost savings of around 4.5 million going forward on an annualized basis. If I now go into where the market backdrop is, asset management has been a bad neighborhood really for the last couple of years, especially in active management, and which has led to pressures on the industry. Organic growth has been scarce. We've had a tremendous rise of low cost of passive alternative products and the dual challenge of higher expected returns from alternative products. Interest rates, whilst coming down, have not come down as quickly. And you can see from the high cash levels that are building up in banks that interest rates staying higher for longer has entered people's appetite or assisted people's appetite to risk. We still continue to have economic and geopolitical uncertainty, therefore more leading towards the risk of trade. More specifically in the UK, having said at the time of the election that a Labour government coming in could be the opportunity to provide stability and direction for the UK economy in the run-up to the UK budget, where there was much uncertainty. That uncertainty around tax, around how pensions would be treated, and specifically AIM stocks, led to a very lackluster UK economy where significant amount of our assets sit in UK equities. And so through October, we saw a higher level of redemptions, predominantly from people taking cash-free portions out of their pensions. And if you think about that, the investment profile of those investors, those eligible to take the tax-free lump sums of in excess of 55, once you're 55, they've been invested in the UK for a longer period of time and a disproportionate weighting towards the UK equity market. Since those elevated earnings in the run-up to the election, then we have seen a tail off in the outflows from that side. The US election is behind us now, and a lot more focus will be on the economic growth trajectory in the US, but probably a more domestic orientation towards that from Trump. One of the others put down is the consolidation of wealth managers and IFAs. It's both an opportunity and a threat. Inside of that consolidation, it means that you've got a smaller number of decision makers. We believe that's actually an opportunity for ourselves because those people are more discerning, are looking much more as to the underlying investment process, which is particularly strong on a LIONTRUST. And so we look to benefit from where those intermediaries are amalgamating, joining together to be able to get a larger part of those savings. So, that's where the headwinds are. The opportunity side is, we believe it's, the outlook for active managers is looking much better. 22, 23, were very weak years for performance. But over the last 10 years, if you look at the combined rate of the S&P, even 11, 12% returns, compounding over that 10-year period. And that has been that fundamental trade of innovation, disruption, combined with that sort of momentum trade of the rise in passives. I think once you start to see that passive funds are now going equally weighting, that itself is an active decision. If you start to look at concentration and risk, we think we're more likely to be entering a period now where you will be rewarded for picking the right stocks. Price discovery comes back into selection. And recently, when I've been speaking at events, one more recently in Madrid, I followed three of the sort of heads of the investment consultants around the world. The two things that they were looking most for was the search for alpha and how to allocate to the right active managers and delivering sustainability. So I think the outlook is there. Attractive valuations exist, specifically in the UK, and for with a savings rate that continues to be too low at 8%, it should be closer probably to 16. There is still a lot of tailwinds behind the industry, and if we go out of this sort of last 10-year period going forward, I think there'll be plenty of opportunity for discovery on prices. LIONTRUST is very much that dual discipline, active management, best-in-class distribution. I've touched already there on where the S&P is and the reasons behind those, the rise of passives there. I think, that concentration and growth, it's a bit like saying that now that everybody has an NVIDIA chip, it is the companies that have those chips, the ones that will start to win and start to be attractive for active managers, where you can start to demonstrate where you can get alpha and not just index returns. So the outlook is much more, we're much more optimistic on, having come through a difficult years. I'll hand over to Vinay now more for the financials.
Okay, right. Thank you, everyone, and good morning. Maybe I'll pick up a few key points from our financial results for the period to 30th of September. I'll start with maybe just spending a few minutes on our capital position, given what Tom's talking about the dividend. The business remains in a very strong capital position. So our regulatory surplus capital is just under 60 million. And even if you take into account the dividend, the first interim dividend payable in January, we still have just under 50 million of surplus capital within the business. So we remain in a strong capital position with circa 90 million of cash on the balance sheet. In terms of revenues were 81 million for the half year, which is down from the equivalent period last year. But you just need to note the equivalent period last year did have significant performance fees included, which were on a couple of funds which were sort of had redemptions we got in relation to a team move. So like revenues are down, but that is a combination of reduced AUM and revenue margin, which I'll touch on in a moment. Overall, that has impacted our adjusted PBT. So adjusted PBT of 25.8 million, again down compared to last year, but pretty much in line with the fall in revenues and in revenue margin. Operating margin, which is a key measure that we use to see how well we're doing, at just under 31%. Again, amongst our peer groups, an operating margin of over 30% is a strong operating margin. So it shows that we're running the business efficiently. Again, the equivalent period last year and the full year number was around that 35 level. Again, last year's half year number and the full year number both impacted by performance fees, which we tend to earn in the second half. So nothing really unusual there. Just the business is performing very well. The dividend John's touched on, 22 pence declared, and that'll be payable to shareholders on the 8th of January 2025, with shares going to 28th of November. If we look at our adjusted profit, just a bit more detail here. I will just show the reconciliation between the stat accounts and the adjusted profit. Key point to point out here, professional services fees remain high. That is in relation to our business transformation program, which I'll touch upon in a moment. Intangible amortization is now 4.5 million, which is a good number to look at a run rate going forward. And no impairments in this half. On the next slide, we've got the detailed adjusted income statement. I'm not going to go through this line by line, but the key points here maybe are to look at costs. We have been in an environment where revenues are down, but our costs, both staff costs and other admin expenses, are both down circa 10%. So it shows, again, we are managing our costs well, and that's a credible performance in a high inflation environment, albeit inflation has been coming down. So cost management has been strong, both in terms of staff costs and in terms of non-staff cost side of things. The other thing I'll touch on is maybe the revenue margin. So you'll see the revenue margin is 60.3 basis points, which compares to last year's full year of 62. Again, it's come down. We tend to guide that revenue margin will come down about a basis point or so. And this is really mostly related to revenue mix. So the mix last year, particularly in the first half, had some higher margin products where we had a team depart. But the reduction to 60.3, is as expected. And we expect with revenue mix, the guidance is that you will see around 1 basis point margin erosion on a year-on-year basis going forward, and we stick with that. Again, here just a bit more detail on the capital position for the business. Again, as I mentioned earlier, we remain in a strong capital position with just under 60 million of surplus capital at the end of September. And even if you take into account the dividend, which is paid in January, by which time we have 4 more months of profit being added to our capital, which is not shown here, we still have, after foreseeable dividends, a strong capital position of £45 million. This slide just shows you our capital allocation framework. So for those of you who've seen us present before, you'll see that there's a new line in share buyback. But in terms of how we allocate our capital in the business, obviously top priority, organic investment, the organic business, to run the business day to day and to expand that. That is the key purpose of the capital that we have in the business. Then obviously dividends, then share buybacks. We've instigated this share buyback program. I'll touch on it more in a moment, but again, now that is a new addition to our capital allocation framework. So we have annually for many years taken the appropriate authority to buy share buybacks, but we haven't bought back any shares for probably over 15 years. So share buybacks are now an important part of our capital allocation framework. And then obviously the last element is if there's any inorganic M&A or team hire type opportunities to expand our product range or distribution, we would look at that. But after we look at the organic dividend share buyback process. The business transformation program. John's touched on this already. If you look at the elements of the business transformation program, there's a number of fund and product related changes that we've made, in particular about merging some smaller funds, closing a number of funds. We closed 4 funds in October, which shows that we're managing our product range. But also we've decided to merge our global fixed income team into our multi-asset team, and for the multi-asset team to use the skill set that I have within the global fixed income team to allocate their fixed income exposure to the in-house team, which now forms part of that team. And again, that allows us to scale up our fixed income team, although revenue neutral, would allow us to have larger, bigger fixed income funds to take out to the market. Another key element of our business transformation has been the transformation of the operating platform that we have. We've invested in both front office systems and data management, partnering with BlackRock's Aladdin business, and also taking further outsourced services from BNY Bank of New York, which gives us much greater scalability and stability in that operating platform, as well as having a cutting edge data platform, which will over time, as AI strategies, for example, develop to make use of our data, make use of AI in our data, both in terms of operations, distribution, and fund management. The other elements of the business transformation program, which we've started in this second half, is efficient management of the cost base. A lot of the work that we've done in terms of making the business more efficient in terms of that business transformation, reducing the product range, bringing it having more focus to that, has allowed us to implement some cost cutting across the cost base. We've outlined that we're going to have a staff reduction of circa 25 people. Some of these are as a result of the business transformation that we've done as we've outsourced certain functions, relying more on BNY and other partners to do the work. It allows us to reduce our headcount and our cost, and also just a matter of that, smaller scale with less products. So the 4.5 million cost saving that we've outlined is mostly staff-related cost savings. There are some operational savings as well in there, but mostly 4.5. And we hope to and plan to implement this before the end of the financial year to see the full benefit of those savings in the next financial year. So I'll hand back over to John to talk about fund performance.
I touched on that earlier, that coming out of 21, this was generating significant inflows. He went into weaker years and a poor year in 22 in terms of performance, and 23 we had a heavy bias towards quality growth across our equity strategies, bias towards mid and small caps in the UK, and exposed obviously to the interest rates sensitive stocks, which had affected performance. But the point here is that 24 has been a much stronger year for us in performance. And if I do the next slide, where if you maybe drill down into some of the teams, standout performance of the European dynamic from the cash flow solutions team, which also demonstrates the effectiveness of the power and the process, and the ability to go on and gain assets there. The fund has gone from a billion in size to over 2 billion now in the last 18 months. With excellent performance behind it. I think it's the only fund that is European in the top 10 gross selling funds in Q3 in the industry. So, good reason to be optimistic there for growth and the team. The global innovation team, innovation and disruption that I talked about earlier, and how to play away, on fundamentals, and away from just that concentration and the risk associated with the drive of passives in this space. Again, the team has over 800 million now, closer to 900 million of us under management. Good, strong process, a very clear, established track record that is going well. And first, and the technology fund also been first quartile over 1 and 3 years. So there. A global equities team. If I'd gone back 4 or 5 years, we would have had a much higher bias of our total assets in UK equities. One of the things we tried to aim with either through the global equities team and the global innovation team is to move more towards client demand for global offerings. And Mark Horton, who joined us from GAM, and his team, combined with the experienced team that we had in place beforehand, gives us another global team with 1.4 billion under management across 10 funds that they run. And again, strong performance through India, emerging markets, the Balanced Fund, and the Global Alpha Trust. Economic Advantage team, very much at the core. Much facing the headwinds of the UK equity market, but it to show that even through the micro cap, small cap, special sits all the way up to the large cap. If I look at the Sharpe ratio, how much return do you gain for risk taken? Number one in the sectors, and also that truly active alpha generation, showing the capture there. So even though the UK equity market still faces its challenges, there are certainly signs more in the last month or so that fund managers are now beginning to get rewarded for stock selection. But what I do see is that team still has an excellent long-term track record, is very much at the heart of the existing client banks that we have of UK asset holders, and is still delivering against a very challenging background. This is just to sort of highlight where those valuation opportunities exist, very much in the mid and small cap areas. And all I think that is required is a small turn in sentiment, and you can well see some of these significant discounts to market levels start to come back into more realistic levels. So we do see it as an opportunity. We manage one investment trust, and Roman and his team around about 1.1 billion in size. It came from the JD acquisition, and again, just to show the very strong share price returns in his more concentrated large cap portfolio, how that has developed. Multi-asset, I think Vinay touched on sort of that Phil Milburn and Donald Phillips, head of rates and credit, will be moving into that multi-asset team. Currently, for the multi-asset team, we have about 1.4 billion that sits in other people's mutual vehicles to give us our fixed interest exposure. With our own resource and team and the experienced managers that we have, that money will come back into being managed either directly or through the vehicles that Phil and Donald run, which will give us the ability to scale up some of their credit funds and their strategic bond proposition, which will make them more competitive, certainly in our European distribution, where the fund selectors look for funds that are more than sort of 200-300 million euros in size. But it will also give us the benefit of adding that investment expertise and specialization into a significant part of the managed funds. And with sustainable, I think Alfred, with commentary and performance headwinds over the last couple of years, and you can see that very clearly demonstrated in the 3-year performance numbers. But again, you can see the improvement and the turnaround in performance in the 1-year numbers going forward. I think that the long-term case for growth in ESG remains strong, with the rise in performance and the appeal for there. I think also the material scope to gain more further market share here. The FCA have putting in place classifications ESG to remove greenwashing, green hushing, again. So the adoption of the labels from the FCA, and we hope to have ours in place by January or in January, will clearly cement the leading position that this team has in that sustainable space, and the opportunity set to become a sort of a core proposition for intermediaries wanting to offer sustainable solutions to investors. So I think with the changes we've made across the business, the strong brand that we have, the high levels of engagement we had over 103 events for intermediaries this year. A few weeks ago, we had over 350 wealth managers at the Science Museum for our annual conference. A few months ago, we had 60 or 70 of the top UK fund buyers at an event at the House of Commons. So we still have that excellent connectivity with the client base. The brand remains strong. It is 4th out of 120 asset managers for communication, 5th for client servicing skills. And if we look at our LinkedIn profile, it has grown by nearly 40% this year. And videos we've done using our connection with London Zoo have had 5 million views. So we still have an awful lot of connectivity. It's very important for us, for a business that's got 90% of its investors in retail and 30% of the PLC investors in retail as well. So that confidence in the brand, getting our message clearly out to our investors is a key target for us alongside of our investment. In summary, we've got a very well-established business. It's committed to true active fund management and best-in-class distribution. That strong brand, excellent client engagement, and an impressive long-term performance track record. And despite the headwinds for 3 years, the short-term performance over the last year, with the outlook for active managers improving strongly going forward, I think puts us as well positioned to have the confidence where we are. I think the improvements we've made to the business generate even more efficiency, both financially and in harnessing data to be able to deliver that. The platform for the business is as strong and robust as ever. With Fortune's we think about to change, be more positive for true active managers that can deliver alpha. Companies with a clear identity, strong brand, aligned with strong distribution, are well positioned to benefit from this. Thank you for your time.
Great, thank you, John. Thank you, Vinay. If you would like to ask any questions, please do post them. We do have 2 or 3 questions already, so do post any others. John, Vinay, you talked about the cost savings. You gave some of the details. Somebody's asked about the details, which I think Vinay's covered. The follow-up question to that is, how does that affect LIONTRUST's ability to compete and to maintain profitability over the long term?
I think if we look at where we were, if we go back a year ago, we talked about costs and putting in place the right target operating model. That's been something we've been looking to do, and but a lot of the action in headcount has come from those efficiencies. Building a more robust, scalable platform which can deal with all aspects of the business enables us to use data in a better way. Other things we've done is to use outsourcing to as best degree as we can, i.e. the only things we want to take place inside of our buildings are the things that we can add value on. So simple things like outsourcing fact sheets to be able to get them produced at a lower cost per unit, but more efficiently and accurately delivered from people who have better skills than that with us. So we've been able to reduce those costs. We've made some changes on the sales team, but we brought in 3 or 4 new people as well to enhance that dynamic and bring that forward. And I've been delighted with what the sales team have achieved, despite a very difficult 3-year period, for the business. The level of client engagement we have, the communication and the enthusiasm within that sales team is strong. On the fund management side, no real difference in terms of headcount come out of the cost savings. Those of you that know us will know that the fund managers should have a revenue share, and that revenue share is split between the members of the teams. So even if somebody was taken out of a fund management team, the revenue pool would remain the same. It's just distributed between the people there. Some of the costs come out from the odd we don't have a Bloomberg terminal or things like that. But in terms of the ability to operate the business going forward, I think we've got a much more robust platform, a much clearer through data vault to be able to handle data and digitalization and delivery, and a stronger operating platform moving forward, one from an ability to load on new teams or other areas as well. So the efficiencies have not come at the expense of the growth.
Yeah, I think I'll just add as well. We strongly feel that as we grow from here, we will see more benefits from the model that we've got in place, and we'll have greater profitability, going forward, because of the steps that we've taken to make the business more efficient and on a stronger platform.
Great. You talked, John. You talked about the market context. Do you want to talk more about why our assets under management have fallen? Is the question.
Our 2 largest of assets back would be the economic advantage team, where there has been negative sentiment towards UK equities really over the last 6 or 7 years, and declining and a shrinking pool of assets. Things that are well documented. And there are probably more structural issues that need adopting and changing with the UK equity market. So in the face of the headwinds, despite having an excellent long-term track record in that space, we've seen outflows, as has all other major players in the marketplace in UK equities. With sustainability, the interest rate sensitivity, and maybe the more negative press on sustainability over a couple of years has also led to the outflows there. Those have been the big areas of outflows. So faced with sort of asset depreciation and outflows as to where we are, I think if I look now, we have inflows in the cash flow team in Europe. And the pivot more towards the global teams is helping, and I think a resurgence in the multi-asset team as well. Yeah, the performance of that team over the last year and a half has been stronger since we put the risk reward profiling tools in place. I think the recent changes in the budget will move things away from what are model portfolio services more towards the multi-asset fund and business for tax reasons. So again, gives me more optimistic on the opportunities for improvements in flows. But and I also touched on the debate between active and passive. There comes a time when that mispricing becomes absurd, and managers that have the courage to deviate away from picking stocks that are rising because of weight of cash and capital allocation. And I think the outlook going forward is significantly improved.
Can you talk about what we're doing to enhance profit, gross profit, and post-tax profit?
I think a key element of that business transformation program has been a greater efficiency in our target operating model, which will help us keep our costs down. And we've seen some of that in our costs compared to the equivalent period last year. Non-people costs coming down by 10%. The headcount reduction again. There's two levers you can pull to increase your profit. One is to increase your revenues, and the other is to reduce your costs. And and John's already talked about the events and the efforts that we're putting in distribution to increase our net flows, which in turn will increase our revenues. You can see from against some of the slides that we've shown earlier, performance has been improving. We had a challenging 2022. That's becoming more and more in the rearview mirror now. The 1-year numbers on a lot of our funds are looking pretty strong. So the building blocks of returning to net flows and growth in revenues are there. So but we still need to we still need to have that positive environment to get those flows. So I think on the revenue side, the engagement that we're doing, the changes we've made on the distribution side to make it more focused, I think will pay off in the short, medium, long term. On the cost side, again, we're managing those costs. So we're not sitting here sort of not twiddling our thumbs, but we are taking proactive action that includes the more focus in our product range. So we've closed the smaller funds. That all funds they take resources to look after them, manage them, and to do the admin that goes around that. So making sure that we have a product range that is fit for purpose has been very, very important. So but it's not all about closing funds. We've just launched three funds for our innovation team in our Dublin range for marketing in Europe. So it's about closing funds that are subscale and don't have that view to raising money, but also launching funds where we think that in the short, medium, and long term that we'll be able to raise money, and we think those global funds in Europe will have the opportunity to raise cash. So a combination of those are our efforts to grow revenues, keep costs under control, and ultimately grow dividends, support the dividend, and support our capital allocation policy, and to enable us to do buybacks.
Next question is often asked: do you see scope for consolidation in the industry?
Yes. In short, I think the industry probably has too many providers, too many unambitious providers. And when I mean unambitious, look at the domain of some of the very large asset managers, insurance companies that sort of run funds on a cost plus basis. The corporate things of governance and risk bring them back closer to the index. So I think if they're not delivering alpha and not delivering returns, as you have the move from defined benefit to defined contribution, where you have the individual owns their assets and they will make more, more of them will vote their feet. It's always a difficult thing to sort of see where and when it is, but definitely with the challenging periods of the last sort of couple of years, I think people are beginning to question some of their business models, ones that aren't as robust. And when they talked about are still maintaining an operating margin over 30%. Some of them, are very much in the low teens, it's all questionable. But consolidation, it is for us, for where we make positions, it's part of, if we can see something that we can add value to and generate for, we're not looking to just consolidate to take costs out of things. It's got to be things that fit into our own benefit, either on the manufacturing side. Is it stronger investment teams? Is it businesses with a track record, with the critical mass that we feel we can grow and develop, like we did when we took the sustainable team on board from LIONTRUST, or businesses that bring us an enhanced or broader distribution opportunity. But I think the UK remains a very attractive marketplace to international investors. Still got one of the largest pools of investment capital in there, and I think as the outlook improves, you will probably see more changes in the space.
We've been asked what are LIONTRUST's key competitive advantages and how
of our clients are in retail. We have an excellent, very strong brand, and we have great connectivity on the distribution side. For a group of our size, we're in the top 2 or 3 on connectivity with the platforms for distribution, much above our weight in terms of brand, and we're very clearly focused on the part of the market we want to service. We combine that with positions of investment excellence, strong adherence to process, creating the right environment to attract the best talent in the marketplace to deliver those alpha performance for our clients. That's where the differentiation is. Everybody strives for it, but I think if you look at where the strength of the brand is, the connectivity with the distribution, feedback we get, everything is there.
Great, thank you both very much. That brings the Q&A part of this presentation to an end.
Perfect, John, Vinay, Simon. Thank you very much for answering those questions from investors. Of course, the company can review all the questions submitted today, and we will publish those responses out on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, John, could I just ask you for a few closing comments?
I think we covered as much of it as we can. If I could just say, I think it's been a challenging period, but I think the improvements we've made to the business on the operating platform, the strong brand, strong distribution, and the improvement in the one-year performance. I think looking at a move away from the relentless flows of passives, an area of price discovery will suit our investment teams well. And I think LIONTRUST has a strong financial position and is well positioned to capitalize on those opportunities ahead.
Perfect. Thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of LIONTRUST Asset Management PLC, we'd like to thank you for attending today's presentation, and good morning to you all.